Well, good morning. We're from the Division of Registration and Inspections. And welcome to our session on inspections. My name is Janet Borgman. I am an Associate Director from our Dallas office in the non-affiliate program, which is also known as the NAF program in PCAOB's Division of Registration and Inspections. I'm pleased to present this session today for our Small Business Forum, and I've got Beth Stoughton here from an Associate Director out of our Chicago office, and Shirley Wee, who is also an Associate Director out of our New York office, who's also involved in the NAF program. Before I begin, we have the disclaimer. So I'll preface our discussion with the disclaimer that the views we express are our own and in an official capacity as members of DRI and do not necessarily reflect the views of the board members, or other members of the staff. Okay, so before we get started, as discussed earlier, the CPE codes will be provided throughout the sessions. Please scan the QR code or enter the CPE code. So I'll give you a few seconds to enter that code. That code is 221. So code 221. Okay. Okay, so in this session, we're going to focus our time on the three general areas. First, I'm going to provide a brief staff update from 2023, which is including some of our observation from those inspections. Second, we'll provide an overview of the 2024 inspections, which are currently underway. And then third, Beth and Shirley will take us through a deeper dive into auditing accounting estimates, including the fair value measurements. And Shirley will talk about audits involving other auditors, which both of these topics are relevant to the inspections of our smaller firms. Beth and Shirley are going to share with you the relevant audit requirements. They're going to provide some examples of the audit efficiencies we've found, and they'll also describe some good practices for your consideration. So let's get started. In 2023, the PCAOB inspected 227 audit firms. We reviewed portions of 793 public company audits that generally had fiscal years ending in 2022. And in recent years, a significant trend in inspections has been a rise in deficiencies among the audit firms. This negative trend persisted into 2023. And however, there has been a stabilization in the aggregate deficiency rate for the Big Four firms, along with improvements in the rates for several other annually inspected firms. Moreover, a detailed analysis indicates that some of the outliers are significantly impacting the overall deficiency rates. In 2023, the aggregate deficiency rates continued to increase across all inspection programs. And 46% of the engagements reviewed in 2023 had at least one Part 1A deficiency. A detailed examination of the 6 U.S. global network firms, our GNF firms, shows that the outliers are significantly impacting the Part 1A deficiency rate, which stands at about 34%. Similarly, the outliers are also influencing the deficiency rate among our U.S. non-affiliate firms that are inspected annually, where the aggregate Part 1 deficiency rate reached 51% in 2023. Now, this aggregate rate doesn't necessarily represent the audited quality of all those individual annually inspected firms in the NAF program. Some of those NAF annual firms have deficiency rates close to 10% in 2023, while others range between 80 and 100%. So in 2023, over half of our NAF triennially inspected firms showed no significant changes in Part 1A deficiency rates compared to their previous inspections. And in addition, 26 of our 82 triennial firms inspected experienced an increase in their Part 1A deficiency rates. And only 5 of these firms saw a decrease in their deficiency rates in 2023. Now, there's various factors that contribute to this, such as mergers, an increase in issuer audits, focus on our regional banks. Many of those contribute to those findings. but simply put, the audit quality at our triennially inspected firms is not improving quickly enough. The rise in Part 1A deficiencies demands immediate attention from these firms. So we have a polling question here. Before I go into discussing the 23 inspection results, I'd like to ask if any of you can remember which audit area was not included in the illustrative examples during a previous small business forum. Okay. All right. So the correct answer is A, auditing accounting estimates. That was not included in any of the illustrated examples that we've had in a prior business forum, but it will be discussed today along with illustrated examples as well as those in audits involving other auditors. So let's point out some of the 2023 areas of common deficiencies that we saw. As it relates to 2023, the deficiencies in controls testing remain a common occurrence in both integrated audits and in when controls are tested in a financial statement audit. One example that the staff observed related to risk assessment and the audit of internal controls, where the engagement team did not reevaluate and revise its initial risk assessments after it obtained audit evidence during the course of the audit that contradicted the audit evidence that supported its original risk assessment. The other area that we've seen issues with is in selecting the controls to test. And an example of a deficiency found there in our smaller reporting entities is where an engagement team did not identify and test the controls that address the risk that the same individual could prepare and post journal entries in the general ledger system without approval. Another area that had deficiencies was in testing internal controls related to the test of design of effectiveness. In that example, the staff observed instances where the engagement team did not sufficiently test the design effectiveness of a control because it didn't evaluate the effect of incomplete information that was available to the control owner, and as such, the ability of the control, as designed, to effectively prevent or detect a material misstatement. And finally, the last area where we've seen some internal control deficiencies is in testing management's review controls. Verifying a review as signed off is not provides little or no evidence as to whether or not that control is effective. An example of a deficiency observed by the staff in this situation is when the engagement team did not evaluate a specific review procedure that the control owner performed to evaluate the reasonableness of the projected amounts of revenue growth and the costs that the public company used in its impairment analysis. So those are the types of deficiencies that we're seeing in auditing internal controls, and they remain high, and the auditors are encouraged to continue to focus on auditor performance in this area. Next, I'll go into some of the common deficiencies in the financial statement areas. So the first area is revenue and the related accounts. So revenue is a frequently selected focus area in our inspections, basically because of the complexities that are often associated with revenue recognition, accounting policies and practices, and then the complexities involved in auditing those policies and practices. So in regards to this area, we've noted some of this. Here's about 3 of the common deficiencies that the staff has observed. When the engagement team didn't perform any procedures on significant assumptions in a percentage of completion basis revenue recognition instance, where the engagement team did not test the accuracy of historical data that it's used in testing procedures related to current year transactions, or where the engagement team did not select a sample that could be expected to be representative of the product revenue population, so the entire population in that situation. A second area that we see some common deficiency is in inventory. And inventory presents its own unique set of challenges due to a significant risk of material misstatement due to complexities of determining the cost of inventory and measuring inventory on hand at a certain point in time. So some of the deficiencies that we've noted there is when the engagement team did not perform any procedures to test the accuracy and completeness of your period-end inventory listing reports, or the completeness of your physical inventory adjustments used in testing the existence of inventory. And another example is when the engagement team did not perform appropriate procedures to test inventory, a movement between the interim date and a period end date when the physical inventory was taken at a date other than year end. Another area where we've had some common deficiencies is in accounts that are impacted by your business combinations. So the business combinations by their nature also impact many accounts, and they include a broad spectrum of accounting estimates, including fair value. Some of the deficiencies that the staff has observed is where the engagement team did not perform sufficient substantive procedures to test valuation and allocation of the purchase accounting, including forecast information used in valuations. And another example is where the engagement team did not perform sufficient substantive procedures to test other significant aspects of an acquisition agreement, such as contingent consideration. The last area that we've seen some common deficiencies is in the investment securities. These investment securities are usually representative of about the second largest class of assets in our banks. And some of the observations of deficiencies that were observed there is where the engagement team failed to perform sufficient substantive procedures to test the presentation disclosures of the hierarchy of those investments in the financial statement disclosures, and where the engagement team didn't obtain an appropriate sample for testing the investments that could be expected to be representative of the entire population of investments. And in another instance where the engagement team did not perform any substantive procedures to test the assumptions that are used in the valuation of investments. So we've covered some of the common deficiencies in control testing and financial statement areas. Now let me move on to some additional categories of common deficiencies. So under some of our other PCAOB standards and rules, some of the other common areas we saw in 2023 in our 2023 inspections related to fraud and journal entry testing. So material misstatements of financial statements due to fraud often involve the manipulation of financial reporting processes by recording inappropriate or unauthorized journal entries throughout the year or at period end, or making adjustments to amounts that are reported in the financial statements that are not reflected in individual journal entries. In this area, I've got about 3 examples that the staff observed deficiencies. One was when the engagement teams did not support its rationale for limiting its testing to only certain journal entries that met identified fraud criteria. In another instance where the engagement team didn't include in its journal entry testing entries that met their fraud risk criteria. And then finally, where the engagement team didn't examine any of the underlying data for support for certain journal entries that are identified based on the risk criteria. The next area that we saw some common deficiencies was in critical audit matters, or your CAMs. So the auditor's communication of CAMs in the auditor's report is intended to inform your investors and other financial statement users about any matters arising from the audit of the financial statements that were communicated or required to be communicated to the audit committee and that relate to accounts or disclosures that are material to the financial statements and involve especially challenging, subjective, or complex auditor judgment in the auditor's response to those matters. So in regards to the CAMs, the deficiencies we found primarily relate to instances in the audit procedures to determine whether or not matters were CAMs. And they didn't always include every matter that was communicated or required to be communicated to the issuer's audit committee related to the accounts and disclosures that were material to the financial statements. So these instances of noncompliance don't necessarily mean that other CAMs should have been communicated, just that they weren't evaluated. We also observed in limited instances within the NAF program where some auditors performed no procedures regarding CAMs. In the area of auditor tenure, we continue to identify deficiency in the auditor reporting related to the year that the firm began serving consecutively as the public company's auditors. In the area of audit committee communications, the deficiencies broadly ranged across all of our firms. We've observed several examples where the auditors did not communicate to the issuer's audit committee. Three of those examples are they didn't communicate an understanding of the terms of the audit engagement in the engagement letter, and they didn't determine that the audit committee had acknowledged and agreed to the terms of the engagement. Another instance, the auditor didn't communicate to the audit committee the significant risks that were identified during the engagement team's risk assessment procedures. And the auditors didn't communicate to the audit committee critical accounting estimates and related significant assumptions with a high degree of subjectivity. As it relates to the Form AP, 2023 is our 6th year in the execution of Form AP reporting, and we believe at this point the firms should be familiar and experienced with the process. Although we've seen improvement in this area in 2023, we still see deficiencies related to Form AP reporting on approximately 10% of our issuer audit engagements that are reviewed. So now I'd like to transition to the system of quality control and some of the common deficiencies we've seen there in 2023. So the PCAOB inspection teams, we conducted quality control review to assess your firm's system of quality control. This assessment includes evaluating whether identified deficiencies in individual audits indicate a defect or potential defect in a firm's system of quality control. One of the areas is in the area of independence, and we continue to identify potential SEC violations of financial relationship matters. These potential violations are mainly with triennial inspected audit firms, and they can include deficiencies related to financial relationships, employment relationships, business relationships, non-audit services, contingent fees, and audit committee administration of the engagement. Another area is in the area of engagement quality review, and we continue to identify deficiencies in the EQR reviews in many of our inspections. The deficiencies are not limited to a single type or size firm, and they're not limited to a specific type of engagement either. The deficiencies observed range from firms not obtaining a required EQR to the firm failing to perform an EQR with due professional care. Another common quality control deficiencies we see is in the monitoring process. So firms, based on your size and structure, utilize a variety of methods to ensure that quality control procedures and practices are established by your firms and that they're suitably designed and are being effectively applied. So monitoring basically involves ongoing consideration and evaluation. And many of the firm's documented systems of quality control indicate aspects of monitoring is performed through your internal inspection procedures, and these are usually done after the release of the audit report date. So we're seeing a lot of post-issuance review monitoring programs. The staff has observed that for engagements selected for review, where a firm performed monitoring procedures on the same engagement that was selected for review by us, the PCAOB noticed instances where firms failed to identify the same Part 1A deficiencies that were identified by the PCAOB staff. For the area of engagement quality reviews, I'm going to refer you to one of our spotlights that's dated October 2023 on these topics for a more in-depth review of the 2020 deficiencies we found in that area. And we also expect to publish a spotlight on the independence deficiencies in 2024. So before we move on, we have another CPE code. So that code is 496. Give you a few minutes to put that one in. code 496. Okay. So that covers the 2023 common deficiencies. I'm now going to transition into our 2024 inspections that are currently underway. Many of our inspection plans for the years were presented in our spotlight that was titled Staff Priorities for 2024 Inspections and Interactions with Audit Committees, that was released in December of 2023. My remarks are going to be focused here on just a few key features from that publication, and I would encourage you to refer to that document for more detailed information. Our 2024 inspection program considered overall business risks present in the audits inspected. And a few of these business risks that we took into consideration included persistent high interest rates, tightening of credit availability and or inflationary challenges, disruptions in the supply chain and rising costs, business models that are significantly impacted by rapidly changing technology, geopolitical conflicts, financial statements that include areas with a higher inherent risk of fraud, estimates involving complex models or processes, and presentation and disclosures that may be impacted by complexity in the public company's activities. So it's important to note that we're continually improving our inspection program using a data-driven and a risk-based approach, with a focus on our riskier engagements. And some of the enhancements to our inspection program include increasing the number of engagements that we review. So during 2024, we made a concentrated effort to enhance investor protection, and we increased the number of engagement we selected at certain annually inspected firms in response to heightened risks in certain industry areas. We have expanded several of our inspection procedures. So in 2024, we continued to perform inspection procedures on every engagement selected for review to assess compliance with certain aspects of auditing standards that relate to independence, fraud, audit findings, audit committee communications, Form AP reporting, the auditor's report, engagement quality review, and audit documentation. And we have continued to increase the focus on the firm's culture of integrity and audit quality. So the audit firms continue to face challenges delivering quality audits, as evidenced by the increasing trend of audit deficiencies in recent years and deficiencies that have been identified that have been recurring for numerous years. So we're very interested in why these deficiency trends are not improving and whether audit firms' cultures are playing a role in this failure to improve. We have focused on improving the timeliness of our inspection reports. Considering the recommendation of our PCAOB's Investor Advisory Group, we've taken additional steps to streamline our internal processes and to enable timelier issuance of our inspection reports. As you may be aware, on August 15th, we published the 2023 inspection reports for 6 of our GNF firms. That happened months sooner than it had been posted in previous years. And we've made significant progress in publishing the NAF triennial inspection reports throughout this year. So beyond the selection factors mentioned above, we've placed continuing emphasis on selecting audits of public companies in industries and sectors with specialized accounting or that were negatively impacted by uncertainties and volatility in the economic and geopolitical environment. So with that, I'm going to transition to Beth, and she's going to start us out with auditing accounting estimates.
Good morning, everybody. As noted earlier, we will go through illustrative examples in 2 areas in which we saw deficiencies in the 2023 non-affiliate firm inspections: auditing accounting estimates including fair value measurements, and audits involving other auditors. For each area, we will discuss what the standards require, common deficiencies that we saw in our 2023 inspections, and good practices that we have observed. The first area we will cover is auditing accounting estimates. The requirements for auditing accounting estimates, including fair value measurements, are included in AS 2501. So what are the key aspects of the estimate standard? First, it applies to accounting estimates in both significant accounts and disclosures. At a high level, the standard focuses auditors on estimates with greater risk of material misstatement through explicit integration of the requirements of the standard with the board's risk assessment standards. It emphasizes the application of professional skepticism, including addressing potential management bias. This is important given the subjective nature of many accounting estimates. Another key aspect is that it includes 3 approaches to substantively testing accounting estimates. Finally, the standard provides specific direction on auditing the fair value of financial instruments, particularly when pricing is obtained from third parties. However, given the short amount of time today, I'm not going to cover this guidance. Also, please keep in mind the requirements in AS 1105 Appendix A, using the work of a company's specialist as audit evidence, AS 1201 Appendix C, supervision of the work of auditor-employed specialist, and AS 1210, using the work of the auditor-engaged specialist. In testing estimates, auditors frequently use the work of specialists. Similar to the fair value of financial instruments, given our short time today, I'm not going to spend time focusing on those requirements. As I just mentioned, there are 3 approaches to testing estimates, and the auditor may choose to use one or more approaches in testing an auditing estimate. Testing the company's process, developing an independent expectation, evaluating audit evidence from subsequent events or transactions. The auditor's decision about which approach he or she takes to auditing an accounting estimate should necessarily be informed by the auditor's understanding of the process of the company used to develop the estimate and the relevant controls that are tested and the results of those tests. So what are some of the things that auditors should think about when selecting an approach to testing an accounting estimate? Well, there's no one-size approach that fits all. How you determine which approach or approaches you use will be informed by several things. Let me go through a few examples here. Testing the company's process may be appropriate if the auditor intends to rely on controls over the process, or if the company uses complex proprietary models to develop the accounting estimate, or if the company's controls over the estimate are ineffective, then developing an independent expectation may be appropriate. If an estimate has multiple components, the auditor may want to use different approaches for the individual components. Of course, if there are relevant subsequent events or transactions, evaluating those events and transactions may be the best approach. So let's jump into the first approach, which is testing the company's process. And we're going to start with evaluating the company's method. The method that a company uses to develop an accounting estimate and the corresponding inputs will depend on the nature of the estimate. For some estimates, like certain fair value measurements, the method may involve the use of a model or another valuation method, such as one that's based on expected future cash flows. For other types of estimates, such as obsolescence reserve for inventory, the method might be a calculation based on historical trends or other relevant data. The auditor is required to evaluate whether the method is in conformity with the requirements of the applicable financial reporting framework. This includes evaluating whether the data is appropriately used and significant assumptions are appropriately applied, and whether the method is appropriate for the nature of the related account and disclosure, taking into account the auditor's understanding of the company and its environment. As you know, in some cases, the financial reporting frameworks may prescribe a specific method to develop an estimate. In other instances, the framework may allow for alternative methods or provide guidance on how to apply a method, including the selection or use of assumptions or data. It is important to keep in mind that the nature and extent of audit procedures to evaluate the method used by the company will depend on the risk of material misstatement. And this may vary based on the type of estimate and the process used to develop the estimate. All right, let's turn our attention now to data. The nature and extent of procedures to be performed with respect to data depend on whether the data is produced by the company or whether it's obtained from external sources. Generally speaking, the requirements in this area align with the existing requirements in AS 1105, the evidence standard. For data that's produced by the company, the auditor is required to test the accuracy and completeness of the data, or, in the alternative, identify and test controls over the accuracy and completeness of that data, and evaluate whether it is sufficiently precise for purposes of the audit. For data from external sources, the auditor should evaluate the relevance and reliability of that data. All right, and we have another CPE code, which is 363. I'll give you a minute to enter that. Again, the CPE code is 363. So now that we've talked about methods and data, I now want to focus on one of the main parts of developing an estimate, the assumptions that are used. So for assumptions, there are two aspects to the requirements. The first, the auditor is required to identify the significant assumptions that are used by the company. And you do that by taking into account the nature of the estimate, including the related risk factors, the requirements of the applicable financial reporting framework, and the auditor's understanding of the company's process for developing the estimate. Said another way, the auditor is going to use his or her knowledge that they've gained from the risk assessment procedures and other procedures to help identify significant assumptions. So what are significant assumptions? Significant assumptions are those that are important to the recognition or measurement of the accounting estimate in the financial statements. The standard provides examples of assumptions that ordinarily would be considered significant assumptions, including those that are sensitive to variation, such that minor changes in the assumption can cause significant changes in the estimate, are susceptible to manipulation or bias, involve unobservable data or company adjustments to observable data, or depend on the company's intent and ability to carry out a particular course of action. And I want to point out that the examples in this standards are not intended to be an exhaustive list of all of the attributes of significant assumptions. Facts and circumstances do come into play here. In addition, the requirements for documenting significant assumptions by the auditor are not new. AS 1215 sets forth the requirements for audit documentation, including a requirement that it contains sufficient information to enable an experienced auditor to understand the nature, timing, and extent, and results of procedures performed, evidence obtained, and conclusions reached. Consistent with that standard, auditors should document the significant assumptions that they identified and the rationale for that determination. The auditor, however, is not expected to document a detailed comparison of each assumption used by the company and compare that to the examples of the significant assumptions that I just described. Once the auditor has identified the significant assumptions, the auditor is then required to evaluate them for reasonableness, both individually and in combination. So let's go to that next aspect, evaluating the reasonableness of significant assumptions, of which there are several requirements. First, the auditor should evaluate whether the company has a reasonable basis for the significant assumption. Recognizing what constitutes a reasonable basis will depend on the assumption. For example, a reasonable basis for implied volatility will differ from the reasonable basis for historical volatility. Some assumptions might be supported by detailed calculations or historical information specific to the company, while other assumptions may be based on industry data. Here, the auditor needs to think about whether the assumption is based on an analysis of relevant information or determined arbitrarily with little or no analysis. So, did the company consider all of the available relevant evidence, regardless of whether it corroborates or contradicts the company's assumption? Second, the auditor should also evaluate if the significant assumptions are consistent with relevant industry, regulatory, and other external factors, including economic conditions, the company's objectives, strategies, and related business risks, existing market information, historical or recent experience taking into account conditions affecting the company, other significant assumptions used by the company and other estimates. For example, assumptions that are used in multiple estimates, such as a growth rate for a specific product line, ordinarily should be consistent with one another. It is important to keep in mind that sometimes assumptions are based on past experience, and management expectations may not be reflective of current market information or be representative of future expected conditions or events. For example, changes affecting a company's industry may affect certain assumptions, such as those related to revenue projections or cash flow estimates. Something to point out is that this standard allows for the auditors to evaluate the reasonableness of a significant assumption by developing an expectation of that assumption. If the auditor develops an expectation of the assumption, he or she is required to have a reasonable basis for that expectation. In some cases, an assumption may be based on the company's intent and ability to carry out a particular course of action. The standard sets forth specific factors that the auditor should take into account in those circumstances, and those requirements are included in paragraph 17 of AS 2501. Now let's walk through the second approach, which is developing an independent expectation. Auditors may choose to develop an independent expectation of an estimate. Developing an independent expectation involves the auditor using some or all of his or her own methods, data, and assumptions to develop an expectation for comparison to the company's estimate. In developing the independent expectation, the auditor should take into account the requirements of the applicable financial reporting framework and the auditor's understanding of the company's process, including the significant assumptions used by the company, so that the auditor's expectation considers the factors relevant to the estimate. The applicable requirements for data, method, and assumptions are going to depend on the source of those data, method, and assumptions used by the auditor. So, when the auditor derives his or her own assumptions or method in developing the independent expectation, the auditor should have a reasonable basis for those assumptions or the method. Here, you would need to consider the nature of the estimate, the requirements of the framework, and other relevant factors. If the auditor uses data or assumptions obtained from a third party to develop the expectation, the auditor is required to evaluate the relevance and reliability of those data or assumptions. Finally, if the auditor uses data produced by the company, significant assumptions used by the company, or the company's method in developing its own independent expectation, then the auditor should test the data, methods, and assumptions in the same manner as when testing the company's process. Auditors may also choose to develop an independent expectation of a range. In those cases, the auditor is required to determine that the range encompasses only reasonable outcomes in conformity with the applicable financial reporting framework and is supported by sufficient appropriate audit evidence. And now for the third and final approach. For some estimates, events or transactions occurring after the measurement date can provide sufficient appropriate audit evidence. The focus here is whether the evidence related to the subsequent event or transaction is relevant and reliable to the estimate. In these cases, you want to think about whether there have been any changes in the company's circumstances between the event date and the measurement date. As the length of time from the measurement date increases, the likelihood that events and conditions have changed also increases. So that covers the requirements related to applying the three approaches for testing. So now we are going to jump into a polling question, which unfortunately it looks like the letters are missing. We'll roll with it. The company reported an allowance for loan losses that included a qualitative reserve component that was based on basis points assigned to various qualitative factors. Which of the following statements is true? A, the auditor was required to test the company's process. B, the auditor was required to evaluate the reasonableness of all assumptions related to the various qualitative factors. C, the auditor was required to evaluate the appropriateness of the method used by the company to develop the qualitative component of the all. D, all of the above, or E, none of the above. I'll give everybody a second to answer. See, most people went with all of the above or none of the above, which is always, those are always favorite answers, right? The correct answer is E, none of the above. With respect to A, there is no, and I can flip back here. So with respect to A, there is no requirement to select the approach to test the company's process. Rather, the auditor should consider its understanding of the estimate in selecting the approach to test. With respect to B, the auditor must first identify those assumptions that are significant. And as a reminder, significant assumptions are those assumptions that are important to the recognition or measurement of the accounting estimate. Then the auditor is required to evaluate the reasonableness of the significant assumptions. With respect to C, the auditor is required to evaluate the appropriateness of the method used by the company to develop the qualitative component of the all when testing the company's process, or if the auditor uses the company's process in developing an independent expectation. All right, so let's take that last exercise a little bit further. The auditor's approach to test the qualitative reserve component of the all is to test management's process. The auditor performed the following procedures. Obtained and read the company's quarterly qualitative factor adjustments, including commentary for each factor, focused on changes in the adjustments from prior periods, and the company's all memo. Identified which of the qualitative factors were significant assumptions, evaluated the changes in significant assumptions in relation to the prior periods, and for certain factors, certain external or internal loan data obtained by the engagement team, and compared the company's reserves and ratios to those of peers, including the total collective reserve and other reserves to the total ALL, and the total collective reserve and other reserves to total loans. So the question is, were the auditor's procedures to evaluate the reasonableness of the significant assumptions sufficient to address the requirements in AS 2501? I'll give everybody another second to read this before I flip to the next side, which has the question. All right, so there's the question. So were the auditor's procedures sufficient to address the requirements? A 50-50 split. Well, the majority got it right, and the answer is no. In this instance, we generally believe it would not be enough. Although the auditor performed certain procedures to evaluate the reasonableness of the assumptions by evaluating the consistency of the assumptions with industry information and historical experience, which are required by paragraph 16B, the auditor did not perform procedures to evaluate whether the company had a reasonable basis for the significant assumptions used and for the selection of those assumptions from a range of potential assumptions. In other words, in this instance, the auditor's procedures provided evidence that the assumptions were directionally consistent with the relevant internal and external data and consistent with peers, but not whether the company had a reasonable basis for the assumptions. And this is a fairly frequent deficiency that we have identified when we review the ALL. All right, and I think we have a CPE code next, which is 681. Again, the CPE code is 681. All right. So let's walk through one more exercise, and now we're going to switch industries and talk about inventory. And in this instance, the auditor developed an independent expectation. So the facts are on the slide. The company reported several types of inventory and disclosed in its financial statement that inventory reserves are recorded for obsolete or slow-moving inventory based on assumptions about future demand and marketability of products, new product introductions, and specific identification of items. The auditor's approach to testing inventory reserves was to develop an independent expectation by applying a historical write-off percentage to total current year inventory. The auditor performed procedures to test the accuracy and completeness of the historical write-off percentage. The auditor then compared its expectation to the company's estimate, and the variance was below the tolerable misstatement. Similar to the last question, the question is, were the auditor's procedures sufficient to address the requirements of AS 2501? And I'll give you a minute just to reread the facts. All right. So were the auditor's procedures sufficient? Well, the majority got it right, and the answer is no. In this instance, there are two concerns related to the auditor's procedures. Before I jump into those two concerns, I want to remind you that in developing an independent expectation, the auditor should take into account the requirements of the applicable financial reporting framework and the auditor's understanding of the company's process, including the significant assumptions used by the company, so that the auditor's expectation considers the factors that are relevant to the accounting estimate. That being said, in this example, the first concern is that the auditor did not demonstrate it had a reasonable basis for the method, because it did not demonstrate why developing the estimate at the aggregate level was reasonable, considering the company took into account several factors related to each type of inventory in developing its reserve. Second, the auditor did not demonstrate it had a reasonable basis for the reserve percentage, because it did not demonstrate how the historical reserve percentage took into account the future demand of the company's products, which the company took into account in developing the estimate. All right. The key takeaways on this slide summarize the points that I have tried to illustrate in the prior examples or exercises. 1, identifying significant assumptions such that the audit effort is focused on those assumptions that are important to the recognition or measurement of the accounting estimate. 2, when testing the company's process, addressing all applicable requirements and evaluating the reasonableness of the assumptions, including those in 16A, 16B, and 17. When developing an independent expectation and using independently derived assumptions and methods, having a reasonable basis for the assumptions and methods used. And now I'm going to turn it over to Shirley, who's going to take us through our last section.
We're going to kick off this section on audits involving other auditors with a polling question. The other auditors' amendments are effective for audits of fiscal years ending on or after December 15, A, 2023, B, 2024, C, 2025, or D, 2026. Wait a few seconds. All right. Yay! Most of you guys got it right. 2024. So the PCAOB amended its standards to strengthen the requirements for planning and supervising audits involving other accounting firms and other individual accountants that perform audit work. Okay, another polling question. According to the 2023 Form AP data, how many % of all issuer audits that use the work of other auditors or refer to auditors? A, 6%, B, 16%, C, 26%, or D, 36%? Right. Oh, most of you guys got it right. 16% it is. So challenges with coordination and communication with other auditors or refer to auditors can lead to misunderstanding of the nature, timing, and extent of work, and thus can lead to decreased audit quality. To enhance the audit practice of all firms using other auditors, the board identified the following areas for improvement in the current standard. Applying a risk-based supervisory approach to direct the lead auditor's attention to areas of the greatest risk. And 2, requiring the lead auditor to perform certain procedures when planning and supervising an audit involving other auditors, including, among other things, understanding whether the other auditors are in compliance with independence requirements, and understanding whether the other auditors has the knowledge, skills, and ability to perform the work. Okay. So in this slide, you'll see an illustration of an audit under the amended standards. You have the lead auditor in the middle, who is responsible for proper planning and supervision. The lead auditor includes both the engagement partner and other personnel from the firm. The lead auditor is replacing the existing term principal auditor. So on the left side, you have the other auditors who are members of the engagement team. So keep that in mind. The other auditors are members of the engagement team, but not under the direction and control of the lead auditor. When the lead auditor uses other auditors, the work performed must be supervised in accordance with Auditing Standard 1201, Supervision of Audit Engagement. On the right side, you have referred to auditors. Referred to auditors are not members of the engagement team, but are public accounting firms that perform an audit of the financial statements of one or more of the company's business units and issues an auditor's report in accordance with PCAOB standards, to which the lead auditor makes reference to in its auditor's report. When the lead auditor divides responsibility for the audit, the lead auditor must comply with AS 1206, part of the audit performed by other independent auditors. AS 1205, must comply with AS 1206, dividing responsibility for the audit with another accounting firm. AS 1205, part of the audit performed by other independent auditors, has been rescinded in its entirety by the amendments. So AS 1206 is in play, and AS 1205 has been rescinded. Okay. On this slide, we have example of who is and who is not part of the engagement team that's provided in the adopting release. The engagement team includes partners and professional staff employed or engaged by the lead auditor to perform audit procedures on the audit or assist the engagement partner in fulfilling their planning and supervisory responsibilities. The main takeaway from this slide is other auditors are part of the engagement team, and referred to auditors are not part of the engagement team, as noted in the prior slide. As a reminder, the work performed by the other auditors are supervised by the lead auditor in accordance with AS 1201. Okay, next we have the CPE code 246. So I'll give you a few seconds to enter that CPE code in. That's 246. All right. All right, another polling question. The lead auditor is responsible for carrying out proper planning and supervision of the A, other auditor, B, referred to auditor, or C, engagement team. And most of you guys got this right too. The engagement team, which includes other auditors. Something to keep in mind as it relates to use of other auditors and amended AS 2101 and AS 1201. Under those standards, among other things, the lead auditor should determine whether the participation of his or her firm is sufficient for the firm to carry out the responsibilities of a lead auditor and to report as such on the company's financial statements. So keep that in mind. The lead auditor should determine whether the participation of his or her firm is sufficient to be the lead auditor. Once a firm has determined its participation is sufficient to be the lead auditor should obtain an understanding of the other auditor's knowledge of and experience in applying SEC independence requirements and PCAOB independence and ethics requirements by obtaining and reviewing a written affirmation as to whether the other auditor has policies and procedures describing how the other auditor determines its compliance with the requirements, and obtaining and reviewing a written description of all relationships between the other auditor and the audit client or person in financial reporting oversight roles at the audit client that may reasonably be thought to bear on independence, and obtaining and reviewing a written affirmation as to whether the other auditor is in compliance with SEC independence requirements and PCAOB independence and ethics requirements as it relates to the audit client. In addition, the lead auditor should obtain a written affirmation from the other auditor that its engagement team members possesses the knowledge, skill, and ability to perform the assigned task. The lead auditor should inform the other auditor the scope of the work to be performed and obtain and review the other auditor's written description of the audit procedures to be performed. And the lead auditor should determine whether any changes to the other auditor's plan and procedures are necessary. And the lead auditor should determine whether the other auditors performed the work in accordance with its instruction by obtaining and reviewing written affirmation as to whether the other auditor has performed the work, including holding discussions with the other auditors, and obtaining and reviewing specified audit documentation concerning work requested to be performed to determine whether the other auditor performed the work in accordance with the lead auditor's instruction. Okay. So we have another polling question. So in an audit that involves other auditors or refer to auditors, the engagement partner should determine whether his or her firm has A, participated sufficiently, B, supervised appropriately, or C, planned appropriately, taking into account the importance, risk, and extent of supervision. Okay. And yeah, kind of most of you got it right. It's participated sufficiently. When determining whether participation is sufficient, the engagement partner should take into account the importance of the location for which the engagement partner's firm performs audit procedures, the risk of material misstatements associated with the location for which the engagement partner's firm performs audit procedures, and the extent of the engagement partner's firm's supervision of the other auditor's work. So in this polling question, in an audit that involves other auditors or referred to auditors that play a substantial role, the lead auditor may use the work of the other auditor or referred to auditor only if that auditor is A, an audit firm, B, engaged in the practice of public accounting, or C, register with the PCAOB. %, of you got it right, registered with the PCAOB. And a list of registered firms is available on the PCAOB website. Okay. Let's walk through a couple examples of deficiencies the PCAOB has identified when performing inspections. So in this example, the lead auditor engaged an outside accounting firm to perform an inventory observation, but did not obtain independent representation from the other auditor and did not include information regarding the participation of this other auditor in its report on Form AP. So this is a reminder for firms to obtain independent representation and comply with Form AP requirements when other auditors are involved. Okay. Next example, we have a lead auditor engage an outside accounting firm to perform audit procedures primarily related to interim reviews. The reminder here is as the lead auditor not to forget to communicate to the issuer's audit committee the name, location, and planned responsibilities of the other auditor. And with that, I'm going to turn things back to Janet.
Okay, so that concludes, well, hang on. We may have another, yeah, we've got one more CPE code. That code is 937. Okay, so 937. Okay, so at this point, we've actually finished up this session a little bit early. We had some questions come through. So, the first one. So we've got a question here. From recent feedback, it seems we need to document all of our considerations versus historically operating under the assumption that those conducting inspections would interpret the context and arrive at the same conclusions. Is this the case, and what are some thoughts on how best to address this? Not sure when you're talking about documenting all considerations, what aspect of the audit you're addressing here.
Yeah.
It's kind of
Involving revenue recognition and we're focusing on in general, our audit work papers do not lay out every single part of our thought process involved in how we were addressing this. In the recent inspection we had, that seemed to be a large issue that was pointed out to us. They wanted to know all of the considerations of how we arrived at it, whereas we historically gone with the assumption that those inspected would understand the context of the transaction generally, because it's all calculated in the trigger, and instead of having to lay out that full interpretation, we assume that you also know the terms of the relevant facts and circumstances pertaining to that type of review and all this associated with it. And it seemed like we almost need to have a lengthy memo discussing every little nuance of it versus continuing to go over that assumption of industry knowledge.
I think that sounds very facts and circumstances specific, so I can't comment on that. But I think the one thing I could point you to is, and I talked about this in my slide, is AS 1215, which talks about, the audit documentation containing sufficient information to enable somebody that is not familiar with the audit to understand the nature, timing, and extent of procedures performed, the results of the procedures, conclusions reached, and audit evidence obtained. So I guess I can't comment on that specific facts and circumstances. I can just point you to that requirement.
Well, with that requirement, though, because it is broad in nature, anybody conducting our work would assume that looking at our work should know the industry knowledge, and there should be certain things that are understood from that versus having to lay it out and having it inadvertently
Again, I think you have to, like Beth said, you've got to look at the AS 1215 standard. I'm sure there were probably lengthy discussions with the inspection team on the deficiency. I think if you have questions on the documentation, that's probably something that you could probably work through with the remediation team. Because again, what you're describing is pretty fact specific, so without us having all the information, I probably couldn't advise you on exactly what has to be in that documentation. We had another question here. One was, how has the recent Supreme Court ruling over Chevron deference impacted the process over enforcement? I can't answer that. Maybe our enforcement team can answer that question. We had another question here, might be enforcement related. There's been statements from PCAOB that there will be more findings and more fines in the next year prior to performing inspections. Do these statements impact the approach and results on exams? I'm not sure that we go into our inspections with the expectation that we're going to have findings. In fact, we have the expectation that hopefully the findings will not be there. But the inspection process is very distinct from the enforcement process. So what we do in inspections is not driven by what enforcement does. So that's about all I can say on that question.
That's not my question, but ask a follow-up. We've heard from other peer firms that the rate of referrals from the inspection program to the enforcement has increased, and that we should be very cautious about how we interact with some of the inspectors relative to our other inspections because of the fear that increasing number of referrals from inspections to enforcement is happening. Is that true, or is that just a rumor that's not based in fact?
Well, again, the inspection process is very distinct from enforcement for a reason. We are not, we're not hand in hand with enforcement. We make referrals to our Division of Enforcement investigations only based on the inspection results of a firm. And some of that depends on the types of deficiencies, the occurrence of deficiencies, that sort of thing. There's no black and white as to what. Well, the rate's increasing because based on the information in the slides, in 2023, our deficiency rates are up. And from what we're seeing in 2024, that doesn't seem to be coming down. Some firms it is. Some of it, I think on some of our non-affiliate firm annual firms, we've seen some decrease in the deficiency rates so far, but for the most part the deficiency rates continue to rise, and then whether or not enforcement pursues a matter, that's enforcement. That's not us. You should always be forthright with your inspection team and discuss the matters and things.
We will be forthright. I think the question becomes like, to the degree which we would take exception to a comment form or not, I'm going to risk getting my firm in trouble.
No, you aren't.
It has been impacted by that. And we are more likely, just to be blunt and honest, we're more likely to dispute a comment form this year than we were in the past year because we're worried about enforcement following up with an inspection. And I don't think that's a good track. I think as we're all, like you said early on, we're all idealistic. We're trying to do what's best for society, what's best for the investing public, what's best for the users. I just think you got to be careful because I think enforcement should be really for egregious things that people have done wrong, not for routine inspection matters. And if it starts influencing how inspections interact with the registered firms, I think that's a bad thing.
Yeah. Again, the inspection process is very separate from enforcement. So when you are discussing the deficiencies that arise out of your inspections with the inspection team, hopefully there is good dialogue between the inspection team. We don't necessarily go and, our next step is not to go talk to DEI after every inspection. I mean, there are processes within our systems to make referrals, that sort of thing. a large part of it is because of the increase in deficiencies in certain firms. So, and we don't, I couldn't tell you when DEI is going to make a determination on what firms they're going to pursue. There's another one here that didn't quite, so it talks about, let me see how much time we have. I don't want to go over here. Okay, so there was another one here on what are the percentage of engagements with Part 1A findings that result in restatements or revisions to the work? And does the PCAOB monitor significant restatements of financials and the trend? I do not have a percentage off the top of my head as to which engagements with Part 1A findings result in restatements or revisions to the work, because we don't interact with the issuers, obviously, and the issuers have to make that determination. So we do monitor restatements during our review process on firms that we are inspecting that have Part 1A deficiencies, and up until it gets up to board approval of your report, we are monitoring whether or not a restatement happened on some of these Part 1A deficiencies. But I don't have a percentage. We can probably look into that and post that on the website.
Would it be a better audit quality understanding of the material misstatements versus just findings and examination, whether the audit quality process is better or worse over time? A lot of the findings are really kind of...
Well, your Part 1A findings are in your report because it's based on our views, it's an insufficiently supported audit opinion. So those are considered to be.
Even though we don't have the percentages, we do have issuers that have restated as a result of the inspection procedures, and it is in the inspection report.
Yeah, the statement comes out of PCAOB that the audit quality standards for quality performance is much worse now than it was several years ago, which I guess would be one question. But the question would be, does that mean there's a lot more misstated financial statements in the public marketplace, which to me it seems like it's less, but several years ago there was a lot more fraudulent or misstated financial statements in significant companies. That you rarely hear about that anymore on an issuer. Yeah, all of that, but that seems to be that when you look at generally that there's not a lot of significant fraud financial statements or you don't hear about it, I guess, in the press. I would seem to believe that there's good quality, or the audits are being, there's the financial statements being produced by issuers that are good.
Well, I think that's all media driven, so we're not the media, but again, we post the results of our audit of the inspection reports. I think you can look at the inspection reports on our website and see the type of audit quality for the firms.
Does the SEC look at it like that, or does anybody look at it that way?
I couldn't comment on what the SEC's views are on that. There's one other one that came up. Let's see. What's the difference between audit and completeness? So what, if anything, is the difference between auditing the completeness and accuracy of client data versus rebalance and reliability of external data? If it's the same, why do the standards use different words? We might.
Yeah, it's a hard question to answer. I feel like it should be easy, but I think if you're auditing an issuer, you have better access to be able to test the completeness and accuracy, right? If you're looking at an inventory subledger, you can test the completeness by agreeing that to the general ledger. If you're talking about relevance and reliability, you don't have that same ability because you don't have the same access to that data. And you're kind of stuck with this evaluating the relevance and reliability. Who is the source? How reliable are they? There is I believe it's a spotlight that exists on evaluating the relevance and reliability of external data that I would point you to. That'll help. I don't know if that answers the question.
Yeah, the spotlights out there are a really good source of information. If you haven't taken a look at some of those, they come directly off of our inspection procedures in most cases. So they're a very good source for the views out there. We're getting close to time here, I think. So I just wanted to thank you all for attending this portion of the session. And I'll leave you with this reminder that much of what I covered today can be found within the various Spotlight documents. It's available on our website. And we hope you found this session helpful, and hopefully you'll find the rest of the information helpful too for the rest of the sessions.
I believe we're now rolling into a break. Is that right? For
Yeah, well, sorry. Why don't we break until?
Okay, we're gonna
10:45.
Yeah, we'll break till
10:45.
10:45.
There's stuff out in the lobby, folks, that are scattered.
Thank you.